In the middle of a global pandemic and an economic crisis, why should we be interested in the wealthy? Well, if we want to understand property markets and asset performance, then the wealthy form a critical part of the story. And the reason for this is that private wealth has become a dominant force driving real estate markets across the world. And as this year's report confirms, almost a third of global property investment is driven by private wealth. And while the institutional investor retreated over the past year, private investors grew their market share. The report confirms how the fortunes of the wealthy are changing. It provides an understanding of their attitudes to risk, identifies what they're investing in, and most importantly, explains what they're set to do next. This year's results reveal a fascinating story. Our data confirms that the global policy response to the pandemic supported the wealthy. Lower interest rates and ever more fiscal stimulus helped to push asset prices higher, and in turn increased the world's ultra-high net worth population by 12,000 people to over 520,000 individuals. The process was seen across North America and Europe, but it was Asia, with 12% growth, that saw the real upswing. And this continues to be one of our key wealth stories, Asia's relentless growth. Yes, the US is and will remain the world's dominant wealth hub over our forecast period, but Asia will see the fastest growth in ultra-high net worth individuals over the next 5 years, 39% growth compared to the 27% global average. By 2025, Asia will host nearly a quarter of all ultra-high net worth individuals, up from 17% a decade earlier. The region is already home to more billionaires than any other, and it is China which is the key to this trend, with 246% forecast growth in wealthy residents in the decade to 2025. While the COVID pandemic is viewed as the biggest single risk to future wealth creation, nearly half of our survey respondents cite the growth in wealth inequality as creating a significant risk. With new wealth taxes and similar measures in Argentina, Canada, and South Korea likely to be replicated elsewhere around the world. In addition, the world is unavoidably going to become less global in the near term, with 84% of our survey respondents expecting to continue to travel less this year, with huge implications for themes from investment to international education. Despite a reduced desire for travel, nearly a quarter of ultra-high net worth individuals are currently planning to apply for a second passport or citizenship, a remarkable 50% growth in a year. While the pandemic has undermined globalization, more critically, it's also placed a question mark over the strengths of cities, certainly here in Europe, but also in North America. Rolling lockdowns have limited access to small urban pleasures. Neighborhood restaurants, galleries and theaters have been shuttered. The future seems to point to the suburbs and even beyond, but as urban guru, Professor Saskia Sassen, explains in our report, history shows us that cities rise, fall, but always rise again. Let's hear more on this critical question from Flora Harley, our deputy editor.
New York City is dead forever. This was one of the headlines being touted as the pandemic ravaged some of the world's leading cities, which appeared to spur a mass exodus. For the real estate sector, how cities navigate the pandemic is absolutely critical and is a key focus in the Wealth Report. However, as we confirm, the exodus was just temporary. Residents fleeing for greener pastures and more space is a notable trend, but our survey results also showed that 2/3 of ultra-high net worths were either more interested or saw no change in their desire for urban areas. Cities are far from dead. They are vital for innovation, knowledge sharing, and wealth creation. To help understand how cities are performing, our annual City Wealth Index uses a number of measures to rank 100 cities globally. We highlight those in which ultra-high net worths prefer to live, invest, and spend time. This year, in the unprecedented fashion which has dictated the past 12 months, we had a tie for the first time, with London and New York inseparable at the top. New York is home to the highest number of ultra-high net worths, with more than 7,700. Yet London has more millionaires, with over 874,000. On the investment side, New York has more global firms headquartered there and strong appetite for real estate from domestic private investors. However, London's global appeal drew in the most diverse range of private investors into the city's real estate and saw the highest cross-border level, with $4 billion invested in the year to September 2020. The UK capital also leads for lifestyle factors such as leading universities. To understand future prosperity, we also look at well-being and innovation across cities, with this broader view seeing some strong results from locations such as Munich, Edinburgh and Seoul. We believe that rather than challenge, the pandemic has created opportunities for cities to evolve into something better. In the report, we spoke to Professor Sasson about how history shows cities rise, fall and rise again. One of the biggest opportunities here is well-being and sustainability. With cities responsible for an estimated 70% of global carbon emissions, they are primed to lead the way to a more sustainable future. The 15-minute city, placemaking, green cities, all of these concepts are gaining more traction, linking to the drive for a green recovery and to improve the health of citizens, which is more prominent than ever. An example of where this is already happening is Barcelona. Home to over 700 ultra-high net worths, the city has placed sustainability at the fore with the introduction of superblocks in 2016 and the Climate Action Plan in 2018. These credentials, along with its 700-year-old cuisine and the unique ability to arrive in the city by super yacht, are drawing a new wave of investment and ultra-high net worth interest. With urban centres having quickly adapted to the pandemic, it demonstrates the vast opportunity to take it further. Cities will continually advance and thrive in a post-pandemic era, becoming even more attractive places to live, to work and to invest.
The centrepiece of the Wealth Report is our focus on how wealth creation and investor attitudes feed into property performance. As Kate Everett-Allen, Knight Frank's Head of International Research, confirms in this year's report, the world's prime residential markets actually thrive because of COVID and not despite it. Over to Kate for more.
Prime residential markets across the world displayed a surprising degree of resilience in 2020. The pandemic led to stronger, not weaker demand in many prime markets. Our Prime International Residential Index, which benchmarks luxury residential prices across 100 locations, both cities and second home markets, provides us with a really unique perspective as to how and where wealth is influencing property markets. In 2020, some 2/3 of the markets that we track registered price growth. And on average, prices increased by 1.9%. That may not sound much, but it's above what we saw in 2019. Low mortgage rates, more fiscal stimulus measures, strong performing equity markets, changing commuting patterns, and property tax breaks in some markets pushed demand and, as a result, prices higher. The markets that responded decisively to the pandemic and saw their economies reopen in 2020 are among the top performers. Auckland leads the index, with prime prices up 18% in 2020, followed by a number of Asian cities. Several North American markets also performed strongly. The standout trend in 2020 was the search for space, as the pandemic shone a spotlight on our homes and how we live. From Tuscany to Tasmania, with the global workforce no longer tethered to offices, people craved a base that could deliver all the things that lockdowns halted. Fresh air, space, views and exploration. But with travel bans in place, demand in most markets was domestic in nature. Many of the second home purchases that we saw in 2020 will turn out to be what we're calling co-primary residences, and the expectations on them will be that much higher. This is just one of the 10 trends that we identify as having shaped property markets in 2020. Then there's the push and pull. Some policymakers are going out of their way to court this new globally mobile workforce, from 12-month welcome visas in Barbados and Dubai to more residency by investment programs. But not all governments are welcoming overseas buyers with open arms. As our attitude survey reveals, the growth in wealth inequality will see calls for more foreign buyer restrictions, as well as cooling measures and wealth taxes. Our Next Neighbourhoods article highlights almost 50 locations that we're tipping for growth, from hotspots for new digital nomads to those markets displaying greater resilience, and of course, those that deliver on space and the great outdoors. But what lies ahead? The pandemic-induced residential mini-boom will continue through 2021. Not surprising, given that 26% of ultra-high net worth individuals tell us they're planning to buy a new home in the next 12 months. Seoul leads our 25-city forecast for 2021, with Asian markets again expected to perform strongly. For London, 2021 is set to be the year that annual price growth moves out of negative territory for the first time in 6 years. For investors and second home buyers alike, all eyes are now on the speed with which commercial air travel resumes and cross-border transactions can normalise. Although be prepared for several localised spikes in sales as pent-up demand is released and the world tentatively reopens for business.